September 16, 1992, Wednesday morning, London. George Soros sat in his office, watching numbers tick across trading screens. The Bank of England was burning through billions of pounds every hour, desperately trying to defend the British currency. Soros had bet £10 billion against them, against an entire country. Most people thought he was insane. The Bank of England had unlimited reserves. The British government had pledged to defend the pound at any cost. Prime Minister John Major's credibility was on the line. But Soros had seen something they hadn't. A fundamental flaw in the system. An impossible position. And he was about to exploit it. This is the story of Black Wednesday, the day one man broke the Bank of England and made $1 billion in 24 hours. To understand what happened, we need to go back 3 years. In 1990, Britain joined the European Exchange Rate Mechanism, the ERM, a system designed to stabilize European currencies before the eventual introduction of the euro. The idea was simple. European currencies would maintain fixed exchange rates with each other. If a currency moved too far up or down, central banks would intervene, buy or sell to keep rates stable. For Britain, this meant pegging the pound to the German Deutsche Mark. The pound could fluctuate, but only within a narrow band, between 2.78 and 3.13 marks per pound. If the pound fell below 2.78, the Bank of England was obligated to buy pounds with foreign currency reserves, push the price back up. The problem, Britain joined at the wrong rate. The pound entered the ERM at 2.95 marks. But the British economy was struggling. High inflation, rising unemployment, interest rates already at 12% trying to contain inflation. Germany, meanwhile, had the opposite problem. They had just reunified East and West Germany. The Bundesbank was raising interest rates to prevent inflation from reunification costs. Higher German rates meant stronger Deutsche Mark, which meant pressure on other currencies, including the pound, to weaken. Britain faced an impossible choice. To keep the pound strong within the ERM band, they needed to match German interest rates. But raising rates would devastate Britain's already weak economy. Deeper recession, more unemployment. To protect the economy, they needed to lower rates, but that would weaken the pound, force them out of the ERM. Political humiliation. Prime Minister John Major and Chancellor Norman Lamont were trapped. They had staked their credibility on staying in the ERM. Major called it the cornerstone of economic policy. But the economics didn't work. The pound was overvalued. The policy was unsustainable. George Soros saw this. And so did other currency traders. They smelled blood in the water. Soros had built his fortune on macroeconomic bets. He studied currencies, interest rates, political pressures. He looked for fundamental imbalances, positions that couldn't hold. The British pound in September 1992 was a textbook case. Soros ran the calculations. The pound was overvalued by at least 15%. The Bank of England would have to spend tens of billions defending it. But the underlying economics were wrong, fundamentally wrong. Eventually, they would have to give up. So he decided to short the pound, massively. Shorting a currency means borrowing it and selling it, betting the price will fall. Then you buy it back cheaper later. Return what you borrowed, keep the profit. Soros borrowed billions of pounds, then sold them for other currencies. Deutsche Marks, dollars, francs. By mid-September, Soros had shorted £10 billion, the largest single currency position in history. Other hedge funds followed. Stanley Druckenmiller, Paul Tudor Jones, institutional investors. Everyone saw the same opportunity. The selling pressure mounted. The pound started falling toward the bottom of its ERM band, 2.78 marks, the danger zone. The Bank of England had to act. They started buying pounds, billions of pounds, using their foreign currency reserves. But the selling kept coming. For every billion the bank bought, Soros and others sold more. Tuesday, September 15th. The pound hit 2.80, close to the floor. The Bank of England spent £2 billion defending it. Soros kept selling. The position was now massive, £10 billion short. If he was wrong, the losses would be catastrophic, could destroy his fund. But he wasn't wrong. The mathematics were clear. The bank couldn't win. Wednesday morning, September 16th. The pound opened at 2.79, 1 cent from the floor. The Bank of England intervened immediately, bought billions in pounds, burned through reserves. Nothing worked. The pound kept falling. At 11 a.m., the government made a desperate move. Raised interest rates from 10% to 12%, a 2% hike. Massive. The message, we're serious. We'll crash our own economy to defend the pound. The markets didn't believe them. The pound kept falling. At 2:15 p.m., another announcement. Interest rates raised again, from 12% to 15%. 15%. Mortgage rates would skyrocket. Businesses would collapse. Economic suicide. The market still didn't care. The pound kept sliding. Norman Lamont, the chancellor, was in his office at the Treasury. Advisors surrounded him. The numbers were devastating. They had spent £15 billion in reserves, more than half of Britain's total foreign currency holdings. Gone in one day. And it wasn't working. The pound was still falling. Selling pressure was relentless. The advisors ran the projections. If they stayed in the ERM, they would exhaust all reserves within days, maybe hours. £30 billion, the entire national reserve, destroyed trying to defend an exchange rate the market had rejected. And even then, it might not be enough. The decision was made. They had to surrender. At 7:40 p.m., Norman Lamont stood before cameras, ashen-faced, defeated. "Today has been an extremely difficult day," he began, his voice tight. "The government has concluded that Britain's best interests are served by suspending our membership in the exchange rate mechanism." Britain was out. The pound was free to float, to find its real market value. The currency immediately plunged, 15% in hours, from 2.78 marks to 2.40, exactly as Soros had calculated. George Soros had won. His profit, $1 billion, in one day, from one trade. The Bank of England had lost £15 billion trying to defend the indefensible. British taxpayers footed the bill. Soros became a legend. The man who broke the Bank of England. The traitor who beat an entire country. In Britain, he became a villain. Blamed for the crisis. Accused of attacking the nation for profit. But Soros had simply recognized reality. The pound was overvalued. The policy was unsustainable. He didn't create the problem. He exposed it. Black Wednesday became a defining moment in British economic history. A humiliation for the major government. Norman Lamont never recovered politically. But here's the surprising part. Britain benefited from leaving the ERM. With the pound floating freely, Britain could set its own interest rates, lower them to stimulate the economy. Within 2 years, Britain recovered. Growth returned. Unemployment fell. The ERM had been a straitjacket, forcing Britain to follow Germany's monetary policy even when British economic needs were different. Leaving was painful, humiliating, but ultimately beneficial. Black Wednesday was a blessing in disguise. Soros's trade taught several lessons that remain relevant today. First, markets are more powerful than governments. Even the Bank of England, with tens of billions in reserves, couldn't defend an exchange rate the market rejected. Fixed exchange rates work only if underlying economics support them. If fundamentals are wrong, the peg will break. It's just a question of when. Second, political commitments can't override economic reality. Major and Lamont staked their reputations on staying in the ERM. They raised interest rates to devastating levels. They spent billions in reserves. But economics won. Reality won. Political will couldn't change mathematics. Third, large speculators can accelerate inevitable outcomes. Soros didn't create Britain's economic problems. High inflation, low growth, misaligned exchange rate. These existed before he shorted the pound. But his massive bet, and others following, forced the crisis to resolution. Instead of bleeding slowly for months or years, Britain faced the reality in one brutal day. Some call this destructive speculation. Others call it market discipline, forcing governments to face reality sooner rather than later. Fourth, what looks like disaster can be opportunity. Black Wednesday felt like national catastrophe, humiliation, economic failure. But Britain's economy improved after leaving the ERM. The flexible pound helped. Independent monetary policy helped. Sometimes losing a battle wins the war. Soros's trade has been studied, debated, criticized, and celebrated for 3 decades. Business schools teach it as a case study. Economists analyze it. Regulators learned from it. Currency crises followed similar patterns. Asian financial crisis in 1997. Hedge funds betting against the Thai baht. The pattern repeated. Governments learned to be more cautious with fixed exchange rates, more willing to let currencies float, less willing to defend indefensible positions. But the fundamental dynamic remains. When economics and politics collide, economics usually wins. When markets believe a currency is mispriced, they will test the peg. If the fundamentals are wrong, the peg breaks. Black Wednesday was one man seeing reality before a government accepted it. One trader calculating that mathematics would defeat political will. George Soros didn't break the Bank of England through manipulation or illegal activity. He recognized an unsustainable position, made a large, legal bet, and was proven correct. The Bank of England broke itself by joining the ERM at the wrong rate, by trying to maintain an exchange rate that didn't reflect economic reality, by spending billions defending a policy that couldn't work. Soros just had the courage and capital to bet against them. September 16, 1992, Black Wednesday. The day markets defeated a government. The day one trader made $1 billion in 24 hours. The day Britain learned that economic reality can't be denied, no matter how much money you spend trying. The pound fell. Soros won. Britain recovered. And the lesson remains. In the battle between markets and governments, bet on markets, especially when the mathematics are on your side. This is the story of the man who broke the Bank of England. Not through force, not through manipulation, but through recognizing reality before everyone else did, and having the conviction to risk everything on that recognition.